Good morning, good afternoon, and good evening to all the esteemed participants from around the world. This is Prem representing NRI services of Ashutosh Financial Services Private Limited. We heartily welcome you all to our Zoom webinar, which will be focusing on investment opportunities for NRIs through Gift City. It is a pleasure to have you all join us as we explore into this significant topic that holds immense potential for mutual growth and prosperity for the NRIs around the globe. Gift City, India's emerging financial services hub, a symbol of modernity and ambition, is all set to act as a gateway for NRIs to participate in the India's growth story, poised to redefine the nation's economic landscape with state-of-the-art infrastructure and a vibrant business ecosystem. The Gift City offers lucrative investment opportunities like never before. Our esteemed speakers for today's webinar, Mr. Daxesh Kothari, who is a tax and financial consultant and MD and CEO of Ashutosh Financial Services Private Limited, along with CA and CFP, Mr. Rajit Kothari, who is an executive director of Ashutosh Financial Services Private Limited. With their expertise and experience, they will provide invaluable insights on the various options available for investments in Gift City, where NRIs can invest their valuable savings profitability in India without any Indian taxation or compliances hassle-less. We have also invited the senior most executives of the asset management companies based out in the Gift City to take part in the panel discussion session, and then after we will be having the question answer session at the end of the webinar. We will start with a short introductory videos of today's speaker, and then we will continue to the core presentation. Thank you for your presence and enthusiasm for exploring investment opportunities in Gift City. Let's begin the session now.
Mr. Daxesh Kothari is a tax and financial consultant and the Managing Director and CEO of Ashutosh Financial Services Private Limited, which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He specializes in the fields of income tax, FEMA, trust laws, estate planning, and foreign tax compliances. On the financial front, he specializes in investment services and insurance services. He advises companies, trusts, high net worth individuals, and non-resident Indians across the globe on financial and tax and allied laws related matters. He is a trustee of various charitable trusts. He has been involved with a number of social service projects of Rotary Club and is a Paul Harris Fellow of Rotary International. He has been presenting analysis on the Union Budget since last 16 years and also on various subjects of taxation and finance at various forums addressing doctors, businessmen, industrialists, taxation consultants, chartered accountants, company secretaries, NRI and postgraduate students of diverse branches on subjects related to finance, taxation and estate planning to make our society financially literate. His articles on financial subjects are regularly published in renowned newspapers like the Economic Times, Mint, etc. and also in magazines like Dalal Street. His interview was aired on ET Now as a mutual fund industry expert in the program named Swatantra, which is one of the most acclaimed investor education initiative of our country. He has also addressed a program dedicated to NRI on a leading Gujarati TV channel in Ahmedabad. He is a 360-degree versatile personality in the fields of taxation and finance, which makes him a unique and truly a one-stop solution provider for a wide range of financial and tax-related matters. Mr. Rajit Kothari is the Executive Director of Ashutosh Financial Services Private Limited, which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He is a chartered accountant and a certified financial planner by qualification. Further, he has graduated in the field of commerce with specialization in banking, financial services and insurance sector from Ahmedabad University and has also pursued post-graduation in the field of law. He started his journey with Ashutosh Financial Services Private Limited, where he played an instrumental role in functioning of several business development activities of the company. He also played a vital responsibility in the development of exotic product offerings for the company in the alternate investment arena such as foreign equity and unlisted stocks. Moreover, he was instrumental in the preparation of extensive knowledge database on different topics concerning taxation and finance for the company. Thereafter, he worked with Messrs. Deloitte Haskins & Sells LLP, one of the leading global consulting firms at Mumbai, focusing on tax and regulatory compliance for high net worth resident and non-resident individuals. He is an expressive public speaker and addresses professional forums on diverse topics related to finance as well as other topics of national importance. He has participated in international exchange program as a student and has also attended management development programs across top business schools in India. As a young and dynamic director with a multi-skilled personality, he presently concentrates on exploring innovative business opportunities through geographical expansion, digital proliferation, and concentric diversification of the company.
Hello, everybody. Before we go to the subject proper of the gift city and the advantages and the features and all those things that we are going to discuss today, I would like to take a couple of minutes on whatever is around insofar as India and the Indian economy is concerned. We all know that India is the fastest growing economy amongst the top 20 economies of the world. And it is maybe for that reason, and maybe much more in terms of governance and the excitement and the China plus one's aspect which is developing across the globe, that there is a lot of interest and investments which are coming to India, especially in last 10 years. Now, in last few days of what we hear, understand, read, is that there is a feeling that what would be the outcome of the Indian general elections. The results of these general elections are around 1 month away, but there is a lot of discussion within the country and outside the country that what would be the outcome in respect of the general elections. The foreign institutional investors and to a certain extent foreign direct investments, quite a large amount of monies are sitting on the sidelines waiting for the outcome of the general elections. As I said, people in India are anxious, and maybe that is the reflection which is happening on the Indian stock market as of now. But what I want to talk is that we need to look beyond such events and such general elections which are happening. We need to look at the fact that here we are talking of a country, an economy, an emerging market which has got such a vibrant democracy. The best proof of this democracy is, howsoever a leader is charismatic, but he moves across the length and breadth of the country seeking votes. Then, if we look at the another pillar of any economy which can offer promise, is judiciary. Here is a country where the highest court of the country can definitely deliver result, or rather judgments, against the ruling dispensation which are not liked or which might not be liked by the government. So the independence of the judiciary is very much in place. There could be just few countries in the world, especially the emerging markets, where a foreigner, a foreign company, a foreigner can sue the Indian government or a government in their own country, in their own courts. Then in last 10 years especially, there have been so many changes which have been done across the board in terms of so many things, maybe the direct taxes, indirect taxes, and these changes are something which are going to be there for good. They are not going to go away with one leader, one political dispensation being in power or another. These are structural changes which has happened insofar as India is concerned. And last but not the least, the aspect that the demographics of India are so vibrant. The 1.4 billion population of India, the aspirational population who is now not going to accept any leadership, any change in government or any governance which is substandard. And this we can definitely see in the way people vote for parties and in the general elections. Today, what we are going to talk of is the kind of institutions and the institutional framework which is in place as far as India is concerned. The regulators in India, the Reserve Bank of India, the banking regulator, and the capital market regulator, the Securities and Exchange Board of India, SEBI, are one of the most agile and most respected regulators in the world. And also certain regulatory framework which has been changed in India. And these things rather are going to make India as a country which is going to move ahead and maybe become a developed economy by the 2047, which is the dream of the present Prime Minister. The institutional framework which I have been talking of is something which is very important, and those changes are the ones which are going to drive the economy. And one of the institutional framework change which the Indian government has contemplated is starting of the GIFT City, which is the International Financial Services Center within our own country. All these years, we have been hearing that a lot of capital, lot of entrepreneurs move to destinations or jurisdictions which offer a lot of advantages in terms of regulation and taxation. And people invest globally, or global investments in India are routed through those routes. We all know those routes, which are maybe a Hong Kong, a Singapore, a Dubai, Cayman Islands, Mauritius. And these jurisdictions are the major jurisdictions which are the ones which govern the flow of funds and investments across the globe. The answer to these jurisdictions is our own GIFT City. Now, going to the basics of what is the GIFT City structure and the IFSC. IFSC is International Financial Services Center. So this is a center, this is a special economic zone for financial services, which has been carved out of India, and it is located in Gandhinagar or near Gandhinagar and very close to Ahmedabad. So this is a earmarked area, a specified area where the government of India is contemplating to develop financial services in this specific carved out area. The legal position of this area, which is a carved out specified area, is different than what is it in India across the country. This specified area has a different set of regulations and different set of concessions than the mainland India. The first and foremost thing which everybody needs to understand when they look at the GIFT City is that the Foreign Exchange Management Act, the exchange control regulation in India, whatever are existent, are not applicable in the GIFT City. The GIFT City or the IFSC area, which is, as I said, called the GIFT City, is an area where the Foreign Exchange Management Act is not applicable. Any transaction with this GIFT City is considered to be a transaction with a resident outside of India, despite the fact that it is a part of India. But the way the regulations have been constructed, that this area will be considered as an area where somebody who is located there would be a person resident outside India. The entire transactions which would be in this special economic, which is the GIFT City, will be in foreign currency. And as I said, it will not be in exchange control regulations. But when it comes to the Indian Income Tax Act, the regulations of the Indian Income Tax Act are applicable to everybody in India. So a person operating from the GIFT City is a person who is a resident in India and would be liable to taxation the way the Indians otherwise in the mainland India would be taxable. But in order to attract capital, the government has given several concessions under Section 10(4)(d) and Section 80(LA) to be specific, which gives a lot of leeway and concessions to units and funds which are operating from this GIFT City. The provisions of the Companies Act, the Indian Trust Act, the Indian Contracts Act, the Limited Liabilities Partnership Act, and all other regulations are applicable to this GIFT City. So the difference is that the exchange control regulations are not applicable, one, and two, there are several concessions which are available under the Indian Income Tax Act when somebody is operating from the GIFT City. The GIFT City, as I said, is the financial services center. So the GIFT City provides platform for the activities such as asset management, banking, capital market related activity, insurance related activity, aircraft leasing, and several other activities. But they are all activities which are related to financial services. And these concessions and these advantages, whatever, are not applicable to any other activity like manufacturing, trading, or anything, which are not covered under the ambit of the GIFT City. There are two areas. One, as I said, the special economic zone, which is the GIFT City, and there is a domestic tariff area which provides services to the GIFT City. So the domestic tariff area, the regulations as far as India is concerned in general are applicable to it, and the special economic zone, which is the GIFT City, the regulations which we discussed are applicable. One of the interesting things which has happened as far as the way the GIFT City has been constructed or the regulations around the gift city has been constructed is that anybody who is planning to take exposure in the gift city by setting up of anything, any kind of activity, did not run from pillar to post or to different institutions or different regulators in India. The International Financial Services Center Authority, IFSCA, is a centralized one single regulator for all the activities which might be carried out or which somebody is planning to carry out from the gift city. All the functions of the regulator like the SEBI, which is the Securities and Exchange Control regulator in India, then the Reserve Bank of India, which is the banking regulator, the pension regulator, the insurance regulator, one need not go anywhere. All the powers of these regulators are subsumed in the IFSCA, which is the single authority. Now, I would like to talk a little about the basics of international taxation. So this is very important when somebody evaluates whether it is advantageous for the person who is looking at the gift city to be a part of the gift city or not. The basics of international taxation are, there are two rules of taxation. And these rules are something which are applicable as a matter of principle of taxation across the globe, internationally recognized principles. The first rule is, a country is going to tax an income which has been sourced from that country. That is the source rule. So whichever jurisdiction somebody has an income, that country would tax that income on the basis of this source rule. Now, that income which has arisen from a particular jurisdiction, as I said, is taxed under the source rule. Now, the another rule is the residence rule. Under the residence rule, wherever a person is a tax resident, those jurisdictions will tax the tax resident in respect of the global income. Just to illustrate that, say somebody has an income which is sourced out of India. So India would say that under the source rule, because this income has been sourced from India, we are going to tax this income in India. Now, under the residence rule, the country where the person, the non-resident, is a resident, say in the US, in a Singapore, or maybe any jurisdiction of the world, that country would say that because you are a tax resident in this country, say a US, we will tax you your global income, which is the income which has been sourced from the US and the incomes which has been sourced from any part of the world. So what would effectively happen is, the income which has been taxed in the source country will also be liable to taxation in the country where that person is a resident. So the fear which comes up in anybody's mind is that then, is my income taxable doubly? One under the source rule where the income has been generated, and one under residence rule where the income, which is the global income, is liable to taxation. The answer to it is the double taxation avoidance agreements. All the major jurisdictions of the world, they have entered into double taxation avoidance agreements, under which incomes which have been taxed under the source rule in a particular jurisdiction, when they are offered to tax in the country of residence under the residence rule, one gets a set off of whatever taxes which has been paid under the source rule. So this is what takes care, and this is what mitigates the harshness or the hardship of somebody where one would not be taxable doubly in respect of the same income. Now we will go into the next part of the presentation, and Rajit will take up the next part of the presentation where he will be talking specifically about the products which are available, the investment opportunities which are available through the GIFT City route.
Hello, everyone. It's always a pleasure to address our fellow Indians who are doing so well, making our nation so proud across the world. Talking about today's topic, the topic of GIFT City and investment through GIFT City has been on the limelight since a couple of months, especially after a series of news articles featuring the special tax regime and the exemptions available to non-resident Indians investing through this route of GIFT City. Whenever we talk about the GIFT City investments, we are not referring to investments in the infrastructure or real estate of this geographical location of GIFT City, but we are referring to investments in the financial assets or the financial markets of India through vehicles which are established in this special jurisdiction of GIFT City. Today, I will talk about two different routes to participate to this special jurisdiction of GIFT City by way of establishment of vehicles for NRIs and investments into the Indian financial markets. Talking about the first route, that is investment into units of Indian mutual funds. This is how the entire process flows. In the first step, the global investors, who could be persons of Indian origin or persons who are not of Indian origins or business entities, contribute by way of investments into the AIFs or alternative investment funds, which in turn invest into units of Indian mutual funds, which could be investing either into the stock market by way of equity-oriented investments, equity-oriented mutual funds, or debt-based investments, or a combination of both through hybrid mutual funds. Now, this IFSC, this AIF is registered in the GIFT City, which is the IFSC, the Special Economic Zone, and it is regulated by a separate trustee and a specific fund management entity, which is in compliance with the regulation of this International Financial Services Center to avail all the tax exemptions and other benefits that I'll discuss further. Talking about the different features which are involved in this particular route, it's firstly, as per the legal understanding, AIF, which is a category 3 alternative investment fund, and the investment is denominated into US dollars, investing into direct plans of a single scheme or multiple schemes of a particular mutual fund. If the AIF is investing into X mutual fund, it could be investing into one or more than one schemes of X mutual fund only. When we talk about the taxation, since this investment is rooted through this special economic zone of IFSC and the fund established in that jurisdiction, there is a special tax advantage or exemption that is available to all the NRI at the fund level and as well as the investor level. So all the investment income in form of gains or any other incomes whatsoever arising out of this investment to the fund as well as to the investor is completely tax free in both the hands because of the special tax exemption that is available under the Indian Income Tax Act. The minimum investment amount as per the regulatory requirements as of now is 150,000 US dollars. This could be in one go or in different tranches, which could range up to 6 to 12 months, depending upon the arrangement formulated by the particular fund. All persons who are basically non-resident under the Indian income tax law, who could be persons of Indian origin, meaning NRIs, or other persons who are not of Indian origin, or any other business entity that are incorporated outside India, are eligible to avail this specific benefit and route of investment that is available. When we talk about the different individuals from various countries who can invest, basically all the different persons who are residing can invest in this kind of offering, except the individuals who are residing in the countries which are either in the blue or gray list of the FATF, meaning all these countries that are mentioned, and barring those, all other countries are eligible to participate in this offering. As far as the exit load is concerned, which is the kind of penalty to discourage withdrawals and to ensure that the investor stays for a long term in the fund, there is an exit load to the tune of 1 to 3% on a decreasing trend for the first 3 years in most of these offerings that are announced so far. When we refer to costs, which are very important for evaluating any investment offering that is there, the fund management fee that is charged by this AIF is in the band of 1 to 1.5% per annum on the entire corpus that is managed for that particular investor, and which decreases with the increase in the volume of the investment that is invested by the particular investor, plus the expense ratio, what is charged by that particular mutual fund on the direct plans of the underlying investment in which this AIF structure invests, is an additional cost which will be indirectly have to be borne by the investor. So the total cost would be a summation of the fund management fee of the AIF as well as expense ratio, whatever is mentioned by the particular mutual fund under that scheme of the direct plan. The most important aspect, the advantages and the entire rationale behind this kind of a route or investing is, firstly, there are no tax implications, as I mentioned, in India. When we talk about no tax implications, one thing to be kept in mind, which we discussed in the earlier part of the presentation, is that there is no taxation as per the source rule, meaning India does not tax any of these incomes. However, there is always the residence rule which applies to the NRIs, meaning whatever is the home jurisdiction, the tax residency of that particular NRI, will that particular country has the right to tax that income. Meaning, for example, if there is an NRI based out of UK who is availing this kind of a route of investing, there will be no tax implications in India whatsoever. However, if the foreign incomes out of these kinds of investments are taxable as per the domestic tax law of UK, such taxes will have to be borne in the UK out of this kind of arrangement. So the NRI needs to keep in mind the kind of taxation that is there in the home jurisdiction. Over and above this advantage of no tax implication, there are no tax compliances as well that are to be carried out in India, meaning filing of income tax returns, handling the assessments, quoting a PAN, nothing at all. Secondly, there is no requirement of opening all these kinds of accounts which are required in other investments, which could be investment into shares or mutual funds, which is opening a demat account and a bank account. The funds directly flow from the bank account of the NRI outside India to the bank account of that particular fund in the gift city. Thirdly, there is an advantage of these investments being denominated in the US dollar currency. Now, we need to understand that since this fund invests into mutual funds, which are denominated in INR, that is the Indian currency, there will always be conversion which would be applicable on these kinds of investments. However, the advantage behind going for this arrangement is that when the fund converts the entire amount received in the foreign exchange to INR, the kind of conversion rate that it can avail on this kind of an investment could be much competitive and better than what an individual investor can avail on remitting those funds to India and then converting and getting a rate of conversion out of these kinds of investments. Hence, at an aggregate level, the kind of valuation or the kind of exchange rate at which our investments through this route can flow can be much attractive than the route in which the individual directly invests himself into the Indian markets through some other way. The net asset value of these investments, which is the valuation per unit of the AIF, is also denominated in the USD currency. And last but not the least, the onboarding process is extremely seamless and smooth, hardly requiring documents in form of address proof, identity proof, and a bank proof, which is very simple and fast track. Now, we need to understand as to what kind of investors are best suited according to us in this kind of a route. Firstly, this route is extremely advantageous to NRIs and individuals residing into countries where there is no taxation on foreign incomes, which could be a Singapore or Middle East countries, and countries where there is no compliance which is usually followed on the incomes arising out of foreign jurisdictions, which could be several African countries. So, for all persons who are residing in either of these two categories in all these countries, this is a very attractive arrangement that can be availed. Secondly, there are several investors with whom we interact who do not prefer opening and going into the compliances of starting and managing a demat account, bank account on a regular basis for whatever reasons. For these kinds of investors, it is a very good offering wherein there is no requirement of opening and going into the formalities of operating these accounts. And lastly, for investors who are not keen on managing the Indian tax compliances, which could be filing of returns, handling tax assessments, this is also a very attractive mechanism. Even though the Indian tax mechanism is now extremely transparent, faceless, and efficient, but still, if there are investors who do not intend to go through this entire route of going for the tax compliances, this can be a very suitable means. Now, I would like to talk about the second means, that is investment, the underlying investment being into equity shares or into some kind of derivative strategies. Understanding the process of this, it remains the same as the first route. The only difference that we need to keep in mind is that the AIF, the intermediate vehicle through which the individuals outside India would be investing, would in turn invest into equity shares which are listed on the Indian stock exchanges, or deploy some kind of derivative strategies into the Indian stock market, while everything else remains as it is, as discussed in the first route of investment. Talking specifics about the features, just as the earlier option, earlier route, this is a category 3 AIF, in which the underlying investment is either into stocks, as I mentioned, or derivative strategies, or a combination of both of them, with the investments being denominated similarly into the US dollar currency. When we talk about taxation, we need to understand that as far as the incomes out of these derivative transactions are concerned, there is a similar kind of tax exemption that is available to the individuals, just as it was available in the earlier option of investing into mutual funds through these units, wherein there is no tax implication either to the fund or to the individual. However, in case of investment out of in case of gains out of disposal of equity shares, there is a tax which is applicable to the fund, not to the investor, which is 10% on long-term gains when the holding period exceeds 1 year, and 15% when the holding period is less than 1 year. So this is the kind of tax on equity shares that the fund will have to bear. Whereas for the investor, there is no tax, since the fund has already discharged the tax liabilities that are as such applicable. Just as the first route, the minimum ticket size as per the regulation right now is 150,000 US dollars. And all the permissible investors that we discussed in the first route are allowed to invest in this route as well. And the exit load also remains the same. The cost aspect is slightly different than the first route, wherein there is a fund management fee, which is the only cost that has to be borne by the investor, which could be in this band of 1.5 to 2.5%, depending on the type of fund, the volume of investment, and along with this fixed fee, there is also option of a performance-based fee that the investor can choose to opt for, wherein there is a kind of profit sharing on the fund attaining a certain kind of return out of its performance. Talking about the advantages, as we discussed, there is no tax on these kinds of derivative income strategies that are deployed. And of course, there is no tax compliance which is also involved to the investor, which is filing of returns and all these things. When we talk about investors who are US tax residents, who are residing primarily in US, for them, there is this very advantageous mechanism that is available, wherein they can claim exemption or they can claim credit of the taxes that the fund has paid from their own underlying investments by way of issuance of these Form K1s, and these credits are available while they are discharging their US taxes against the gains out of these Indian shares under the double taxation avoidance agreement. So for anyone who is investing from the US, there is no tax on the derivative incomes, number one. And as number two, as far as the taxation which their fund bears out of the equity shares transactions, they can get a seamless credit while they are paying their US taxes by way of these Form 1s which are issued by the particular fund. Just as the last route, there is no requirement of going into the hassle of opening demat account, bank accounts, and there is a direct flow of funds from the foreign bank account to the GIFT City bank account. And the USD conversion rate exchange benefit also remains as it is, and it's the onboarding process is quite similar and extremely seamless and simplified. Talking about its suitability, this option is also available to countries and individuals who are residing in countries which are under this FATF grey and blacklist, which are all these countries. If there is an individual who is based out of these countries and finds the advantages of going through this route attractive, then someone can opt for this kind of a route and avail this benefits of investing through the GIFT City. And other suitability remains the same for investors who are not keen to manage these affairs of opening and managing bank account, demat account, and the Indian tax compliances. Also, there is a certain category of investors who are interested in looking for strategies of derivative incomes in the Indian financial markets. Even for them, this becomes a very worthwhile route to have tax-free incomes out of these kinds of transactions with all of the benefits that we discussed earlier. This brings us to the end of both the routes and the entire presentation that we wanted to convey and bring to your understanding in a very crystal clear and a concise manner about the kind of mechanism through which an NRI or any other person can participate through the GIFT City route. I would like to talk a brief about our company and how we are structured in order to facilitate the Indian community across the world. We have a legacy which is more than 65 years old, and we proudly take this step of serving as a one-stop solution for all kinds of financial needs that the NRI could have through our dedicated team of relationship managers, which is there. We have got our active presence in all these three locations, which is Mumbai, Ahmedabad, and Rajkot. We manage about more than 800 crore Indian rupees in the Indian as well as financial markets of about more than 5,000 individuals who are from 22 different countries, including India. We have a team strength, which as well as represent is a strength of 60 plus people with representatives even outside India. This is our upcoming corporate house, and if any one of you happens to visit any of these locations, then it would be a pleasure to meet you in person. This is a general disclaimer that all the views that were discussed by us were personal in nature, and it should not be construed as a professional advice. And all the further on discussions that we would be having through the panel discussion would also be the views of those particular panelists, and it should not be taken as any kind of professional advice. And wherever we have used any kind of data, we have mentioned the references. Thank you so much to everyone for sparing their valuable time on this weekend and attending our webinar. Uh, in our initiative of spreading financial awareness to our fellow Indians across the globe, we would like to, just as the last time when we took this survey from you, just as the last webinar when we asked you the kind of topics and that would be interesting for you and that you are looking forward to participate, we would again like to ask you the topics that would be of interest to you for the upcoming webinar so that we can try to empower you in that particular topic, and so that your understanding about India as a market and several other nuances which are a fallout of that becomes even more better. So can we have the poll, please? To request everyone to give their important vote for this so that it helps us in for. Can we have the results? Okay, so I can see that there is a tie between two different topics, which is Indian taxation regulations and repatriation of funds, and building an investment portfolio that can deliver returns beyond the normal. So we'll try to bring out topics on both these different issues which are very important through various webinars in the future. Thank you so much for giving your valuable feedback. And we have a repeat session of this entire topic that we discussed today at 4 p.m. IST. So if anyone wants to attend the session again to have a better understanding or intend to circulate this amongst your friends, relatives, please feel free to share this information with them, and they are most welcome to join on the repeat session at 4 p.m. today. We'll now move forward with the panel discussion.
Thank you, Mr. Daxesh Kothari and Mr. Rajit Kothari, for giving us the insights on the GIFT City offerings. Now let's move forward to the panel discussion, and let's welcome to the panelists from the asset management companies to join us for the same.
So moving forward with the panel discussion on GIFT City to have more and more participation from experts who are into that field day in and day out. We are extremely fortunate to have the top level executives of all the funds practically that have got some kind of a meaningful exposure and interest in this GIFT City investments today. Introducing each one of them in person. The first panelist, Mr. Manas Kumar, is the head of products and business development at HDFC AMC. Has a glorious experience of more than 2 decades in all these different kinds of domains. He has also worked with other AMCs in the past and is a IIT IIM graduate. Moving forward, Mr. Ashish Mohanot is the key nodal person, that is the principal officer of the GIFT City outfit of HDFC AMC, that is HDFC AMC International IFSC Limited. And similar to Mr. Manas, he also has experience of more than a decade into these domains and has closely worked with other asset management companies in the GIFT City landscape, as well as several other different kinds of companies, and he is a CA and a CSI qualification. From the other AMC, we have Mr. Vaibhav Shah, who is the head of business development strategy from Mirae Asset Management, which is a globally acclaimed asset management company. He also has experience of more than 2 decades into the financial markets and has served in various different domains for mutual funds and AIF alternative investment offerings and in several renowned organizations. And he's also a CA, CFP, MBA by qualification. Mr. Ritesh Pathak is also from a very reputed asset management company that we know about. He's the executive vice president and the national head retail sales of Motilal Oswal AMC. And he has a glorious experience into this field of development and distribution of about 2 decades, and has also worked across different companies in the asset management space. He's also MBA by qualification. So now let us move forward with discussion with all these experts into various different kinds of funds that they represent. Starting with Mr. Manas and Mr. Ashish. So, firstly, a warm welcome for being a part of this initiative of ours. Thank you so much. HDFC has been the pioneer and the first AMC to start offering into the GIFT City. So, can you throw us some light on the brief about how your fund in specific is structured, and what kind of investors should ideally look at this offering of yours?
Thank you. Let me first thank both you and Daxesh Bhai for the opportunity that you've given to us to be part of this panel. Big thanks for that. So I'll just briefly give a background as to what our business in GIFT City is and what is the nature of products, or how we've gone about trying to see what would be the viable option of investors looking to invest in a certain segment of products from GIFT City. So HDFC AMC, the India entity, has created a wholly owned subsidiary in GIFT City. That subsidiary has gone ahead and taken a retail fund management license with the regulator there, with IFSC authority. So with a retail license, I'm permitted to do everything, right from retail to alternate to PMS. So the whole suite of products and solutions which an asset manager can offer is available to us under the retail FME license, as it's called. What we've then gone and done is we've gone ahead and launched 6 funds, and these funds are in the nature of Category 3 AIFs, Category 3 alternate investment funds. And each of these funds separately feed into one of our mutual fund schemes in India. So we've tried to keep a slightly diversified bouquet. So of the 6 funds that I talk about, we've got 3 on the equity side, which is on flexi cap, small cap, and mid cap. We've got 2 hybrid solutions, so feeders onto our Balance Advantage Fund and our Equity Savings Fund. And there's one feeder onto the HDFC Nifty 50 ETF, which gives also a large cap and passive exposure to India. So, so it gives you somewhere best of both the worlds. The underlying funds are liquid retail mutual fund schemes in India, which have multi-year track record, which have significant size, which have the backing of an investment team, which a lot of investors are familiar with. Added to that is the overlay of a open-ended Category 3 AIF feeder structure in GIFT City. Now, what it does is, one, from an investor perspective, it provides you daily liquidity. So you have a daily subscription redemption option available for investors who want to invest into India from an overseas fund jurisdiction, which is GIFT City. The only difference comes in that because it's an AIF, it becomes a private placement product. So it is not a retail fund. And then there is a minimum requirement of 150,000 US dollars, which is approximately about 1.25 CR currently, which investors have to put in. And that's from a regulatory perspective. So that's a constraint we had when you set up a AIF in GIFT City. The next point which you had as to what are the nature of investors that these products would be suitable for. So I'll split it into 3-4 different category of investors from which we've seen interest. Beginning with the traditional NRI segment. So there are two categories of NRIs. One is people who already have NRO, NRE accounts in India and are investors in India. So they're aware of it, they're familiar with Indian funds. Apart from whatever they invest domestically through the NRO, NRE route, they now have an option to come directly from whichever jurisdiction they are based in into the GIFT City funds under dollar denominated. So the underlying assets are rupee, but these are dollar denominated products. The second NR segment, which potentially did not previously access India, were, say, second, third generation NRIs, people who don't have a PIO or an OCI card, or the whole Aadhaar PAN might not be available. Now, with this GIFT City structure, even if you don't have a PAN card, you can just provide a no PAN declaration and invest with a respect whatever tax identifier of your country. The third segment is possibly what I'll call quasi-institutional segment or mid to large institutional segment. So there's one very large institutional segment, so sovereign wealth funds, large government entities, etc. Some of them do come through GIFT City. Some of them might want to directly have an FPI license into India, right? So apart from NRIs, you need a foreign portfolio investor license to invest into India. Now, for a large segment of these investors, instead of taking an FPI license in India, they can now directly invest into a GIFT City fund. So this becomes an opportunity where you let go a lot of your operational and regulatory requirements of coming onshore in India and you invest it directly into GIFT City. The last segment I'll talk about, which will take some time to grow and we'll have to see how it's, is the distribution-led business for what you could call as pure foreign nationals and, say, family offices and fund of funds, etc. Right? Apart from the Indian connect. So even this segment, so foreign HNIs, family offices, etc., can now directly access India through GIFT City, which they previously didn't have an option to. So I hope that answers your question on the category of investors where we've seen interest.
Yes, very well. And thank you for the nice explanation. So from what I understood, basically these 6 offerings would be 6 different AIFs, which would be investing into a particular scheme of HDFC mutual funds. So if it is a HDFC FlexiCap AIF, then it would be investing into the HDFC FlexiCap mutual fund scheme, which is existing right now. Is that
yes,
correct?
So to keep the terminology simple, HDFC India FlexiCap invests into HDFC FlexiCap Fund. HDFC India Midcap Opportunities Fund invests into HDFC Midcap Opportunities Fund. So at least there's no confusion. And given that these are global funds, we've added India to the name, as is typically, because in India, obviously, you don't need India in the name of a fund. So the exact feeders for each of these funds has primarily the same name with India added to it.
Perfect. Thank you so much. And talking about the process of onboarding and the time that could be involved in this process. Could you throw some light on that?
So the documentation is very similar to a Cat 3 AIF. Both the way you have in domestic, obviously there are certain changes and other requirements given that investors are overseas and because it's IFSC. The gift regulator has a working group which has been working on digital onboarding, but that is currently not fully in place. So the documentation to a large extent is still physical. What we've tried to do, at least on our end, is to see how much we can streamline it. So as a process, what we do is we review, and whatever kind of back and forth is required is all done on scans, right? So on soft copies between our team in Gift City, the investor onboarding team in Gift City, and the client or the intermediary, in case we have clients coming through distributors, we would work on reviewing the documents, any changes that are required to those. And once everything is final, it's at least there's just one last requirement that a physical set of documents have to be couriered across to our office in Gift City.
Okay. That pretty much explains the entire process. Thank you so much for both the answers that you gave in such a concise manner, and let us hope that a lot of Indians and the entire Indian community across the globe, which was not that keen probably so far, and the next generation now starts having a different perspective and starts participating through this seamless structure that has been enabled by the regulator.
Thank you.
Thank you. Moving forward with the panel discussion, we have Mr. Vaibhav Shah from Mirae Asset Management. So a warm welcome to Vaibhav ji. Mirae has also launched a similar kind of a route wherein through the Gift City, wherein the investors outside India can participate into Indian markets, and that too the mutual fund units of Mirae Asset Management. Can you similarly throw the light on the different offering that you have in place, and also what are the kind of investors similarly what you are looking at out of?
No, thanks. Good morning to everyone, and thanks for giving us this opportunity to maybe share what we are doing in the Gift City. So, like Manas from HDFC mentioned, similar to them, we have we have in the Gift City FME retail license, which means we can do all top sort of products, right from mutual funds to AIFs, PMS, ETFs, etc. in the Gift City. Currently, the regulatory framework is such that it prefers or gives more benefit to get money through the AIF route. Hence, we've started our product offering with an AIF product. Slightly different to what my earlier speaker mentioned. What we tried to do in our first product offering was, considering that an NRI, when he wants to come to India, he would want to get an entire exposure of India rather than have various other options to invest in. So we've launched a fund of fund scheme, which will have different underlying schemes as part of the strategy. So we've created a sort of a smart beta quant model, which runs on factors like valuation, momentum, and others to help decide how much to allocate between large cap, mid cap, small caps, and themes. And basis the allocation which comes out in large cap, mid cap, and small cap, then the allocation is underlyingly done in the mutual fund schemes. So if, for example, large cap allocations throws at 50%, then that 50% will be invested in large cap fund of ours. If mid cap allocation is 30%, it will be invested in our mid cap fund. If the allocation is 10% in small cap, it will invest in our small cap fund, and 10% is coming out to a theme that we remain very positive on. Say, for example, consumer, which is a structural theme, and valuations look attractive to us, then 10% might be invested in that theme. And it's an evolving thing, so percentages or allocation can keep changing on a real-time basis. The idea is, instead of an investor getting allocation to one segment only, say large cap or mid cap, we wanted to give in one product the complete exposure to across market caps and themes in India, so that investing becomes simple for investors. This is a Cat 3 AIF, open-ended in structure. So $150,000 is the ticket size. Investors can come and invest any day and can redeem any day with $150,000 dollars ticket size. And what we've also tried to do is try and market, of course, to NRIs, foreign nationals, and foreign corporates. But we have worked with our RTA to create a digital onboarding journey. So what we've done is completely investing will be online. So partners can invest for their investors online. So documentation can be taken online, and everything is online rather than doing it through the physical mode. So the entire flow will become like mutual funds that you can invest online. We have to try to make it online, so it is far more easy, simple for investors to do it. Partners can put in the details for investors online, and once all the documentations are in place, investors will get an email to verify all the details uploaded, and then they can sort of verify it and through an OTP confirm that the details are true and the transactions can go through. So it is digital in nature. Idea is to give complete exposure to India, and currently by investing in mutual fund schemes, there is a added sort of benefit that it becomes more tax efficient for investors. It gives you simplicity of showcasing funds which already have a proven track record, funds which are already large in size and scale, and you have a proven fund management team managing those products. So investors can get that access along with the digital journey to make their investments. And target segment, of course, like we mentioned, can be anyone from NRIs to foreign nationals to foreign corporates. And this is the first product, which is an inbound product into India. And as we go ahead in the next couple of months, we'll be launching more products, which will provide different flavors to investors.
Perfect. Thank you so much for that. And from what I understood, basically this is a dynamic kind of offering that you are trying to build, wherein this fund would be investing basis the different kinds of momentums that are there in the market, as well as different kinds of categories of the companies, which could be a large cap, mid cap, small cap kind of exposure, and that would be dynamically managed through the model that you carved out, basically.
Yeah, I just wanted to add, the model is dynamic, considers valuation as the first most important filter, and momentum to ensure that you also don't miss out any trend which is there. But the underlyings are funds. So when it shows 50% should be invested in large cap, ideally we will invest in our large cap fund, which has a long track record, proven history, NAV, and a sort of a decent size, which we can demonstrate to investors. Similarly, mid cap will go to the mid cap fund and small cap to the small cap, and so on. So the underlyings are funds, not stocks. And those funds, they have an existing track record, fund management team managing them. So it is dynamic, you are right. But the only difference I wanted to say is funds rather than stocks.
Perfect, perfect. Great. And is there any chance wherein you also intend to have some kind of a debt or a hybrid exposure to this, or it's a pure equity kind of exposure that you are looking at as of now?
You're right. So this is a first fund of ours, and to make it completely tax efficient, we didn't want any other instrument to be commingled with it, because that would have impacted the taxation of the fund. So that's why this remains a pure equity fund. The future funds will have a mix of hybrid and international funds as well, which we can offer. So maybe in a couple of months, we'll be launching a couple of more other funds. But in this one fund, you can get complete exposure to India rather than having one different segment for large, mid, or small or something, or different themes. Everything you can go and invest in India in one go. See, investors ideally NRIs living outside India would want to have at least one fund through which they can get complete exposure to India rather than one segment. Because today, say example, large cap looks attractive. Maybe after a year, mid cap looks more attractive. Maybe small cap becomes more expensive. So you don't want investors to be able to redeem one fund, go to another fund. This can be done dynamically within the entire strategy and make it more easy for investors.
Now, Mr. Ritesh Pathak. Yeah. Hello, Mr. Pathak. Thanks for being a part of the panel. Okay. He's on mute.
Thank you so much, Daxesh and Rajit. I mean, pleasure to be a part of this session.
Yeah. The question which was up in my mind listening to both the asset management companies which are offering, wherein the underlying investments into mutual fund units. So how will this product from Motilal Oswal be different from the ones which we have been discussing or rather has been discussed by both the panelists? How different it would be?
Yeah, it's slightly different compared to what Manas and Weber just mentioned. So the setup is similar actually, just like any other fund in India. So we have set up a trust in IFSC, and it's a category 3 AIF, the CHG, which we launched. This is a product where we mobilized around 3,000 crore last year in our category 3 AIF in India. It's a strategy based on investing only in the businesses of the founders. So our CEO, Mr. Pratik Agarwal, has been managing a similar kind of portfolio in his last stint with the ASK for around 12 years. And this strategy is basically focused on the wealth creation, which is done by the businesses which are led by the founders. If you go through the wealth creation study of Mr. Ramdev Agarwal, our chairman, the company, what we have seen is that over the last 25 years, out of the fastest 10 companies, 9 were of the one which were led by the founders. Out of the 10 biggest wealth creators, 6 were of the led by founders. And if you look at in terms of the fastest in terms of the wealth creation, 9 out of 10 were led by the founders. Over the last 25 years, if we have to put up a data and see companies where we've made the maximum money, it would have been led by the founders. Even in Nifty last 10 years, in Nifty, the founders-led business was 50% of the total market cap. Now it is close to around 69% as per the data we looked at last year by December. So a very, very, high wealth creation by companies led by founders. So what we did is that we chose this product for our first offering in the AIF category 3 in the through our Gift City product. And what we are doing is that in this product is that we are choosing 80 to 100% those companies which are actually have a minimum 26% stake of the founders, minimum 100 crores of PBT, and companies where the ROCE, return on capital employed, is 15%. And in nutshell, we'll end up with around, let's say, 15-20 companies in our portfolio. And we have chosen certain themes for the next 3 to 5 years. For example, we are looking at luxury consumption. We are looking at the solar energy. We are looking at the some of the benefits of China Plus One. We are looking in terms of some of the mid cap IT company, newest technology, and we have made a very widespread, diversified product of around as I speak, around 23 stocks. And in the last 1 year, the fund has actually delivered a close to a 23% alpha, and that is where we thought, let's make it the first product to launch to our clients in the category 3 AIF in Gift City. Like Manas and Weber mentioned, its a process remains same. As of now, we are on the fiscal application mode. We are working for the digital mode, which we should be ready very, very soon. Like Manas mentioned, we are also taking the fiscal application. The client has to send a scan copy. We will check it and we will inform them, and then they can fund a account to us. and then the allotment can happen. As of now, we are doing the allotment on a weekly basis. Every Monday, we are doing the allotment for the client, and the redemption would be on a monthly basis for the investors, and they will get the account statement and all the required details, the statements on a monthly basis. And this would be managed by our team based out of Mumbai. Yeah.
So nicely explained, Riteshji. So what I understand is that the products offered by HDFC and Mirae, the underlying investments would be in their respective mutual fund schemes. While as our investments or the Motilal Oswal investments, which we are talking of, would be investments directly into specific stocks, which the fund manager would look forward to in respect of the kind of portfolio which is planning to build.
Yeah, it would be like rightly said, it would be category 3 EIF. So it will be managed, as you are aware, units are issued to the client again those investment. And I believe it's a good diversification within this call, because there are two asset management offering mutual fund, and we are offering the alternate. So it's a good spread for the client also in terms of products.
So the investing fraternity has got a broad, wide menu of choosing. Yeah.
And just to add, we are also looking at coming up with our mutual funds. So I think very, very soon you will see some more of flagship products. For example, our Motilal Oswal Mid Cap Fund, which is one of the top quartile fund in the industry over the last 10 years, and one more mutual fund. So we are very soon will be coming up with a mutual fund which will work as a feeder, just explained by Manas, will work like a feeder fund, and client don't have any requirement to give their PAN numbers for the Gift City product, because the setup is at Gift City, so no mandate for that. And it is a very simple process for somebody who wants to invest in the US dollars, any NRI, or maybe like people who have of the third or second generation living outside India, and they want to use up their money which is in dollars. So that's a good product to invest in.
Right. So very nicely explained the details of the offering. A small question to Mr. Ashish Manod. Yeah, can you unmute? Yeah.
Yeah, hi sir.
Yeah. Mr. Manod, we have been discussing of the products which are already there, the ones which are there on the board, on the offerings which are active. So on the basis of the discussions and the deliberations and the plans which are there, what are the different kinds of new age products, or the products which the Gift City, the Gift City management or the Gift City offering is looking forward to offer in some times to come?
So thank you for that. There are other options available for various asset management companies which are under process, or currently we are also thinking on those lines. There can be outbound funds where we can source money even from resident individuals in India, and then they can invest into, means our fund can invest into overseas market. So that is one option which is available with various AMCs that they can launch in. And there can be some thematic funds which can be launched from Gift City and can be invested directly into various themes into Indian markets. Apart from that, there can be some associations with other companies where we can create feeders into those associated partners, where global exposure can be provided even to NRIs as well as RI. So these are few opportunities which are there, which you will see maybe in couple of years once these funds, which all AMCs have launched, are well established and they have a base of investors. Then you will see more new type of investment opportunities coming to all those investors.
Fine. So now we have got a lot of understanding of the regulatory part and the basics and the specific offerings by the asset managers. So now I think we'll go for the Q&A session. where if there are any specific questions on whatever we have been discussing, we can address those questions.
Yes, so I have listed down the questions from the chat box, and let me start with a couple of them. So there is a question from Mr. Anand Raj Jain, and he's asking that are the GIFT City offerings similar to the offerings which are available there in Mauritius and Singapore jurisdictions, or this is something different thing comparing to them?
Right. So, just as the other jurisdictions which are global financial services centers, which could be Singapore, Hong Kong, Dubai, GIFT City is also a similar kind of initiative that the government has tried to initiate. Now, the difference essentially lies is that it is very close to the Indian financial markets as compared to the other jurisdictions which are outside India. So the GIFT City, since it is very much geographically present in India, the kind of offerings and the underlying investments that could flow into the Indian markets through the GIFT City route could be much more in depth and could have a much better kind of coverage as compared to funds which are basically passive kind of opportunities which are today available through the other jurisdictions of probably Mauritius or Singapore as far as the Indian markets are concerned. When it comes to the tax advantages and the other aspects of the operational convenience, it remains pretty much the same, and the regulator has tried to provide that just as other jurisdictions. But the only essential difference which lies is this kind of a holistic offering, which is broad-based by several different asset managers who have a very deep exposure and an experience of working into the Indian investment arena.
So just to put in nutshell, if you are planning to take an exposure in India, then the GIFT City route could be a route which will be on the regulatory, on the taxation front, both would be an advantageous situation, and it would make great sense routing those investments to the GIFT City route rather than a Mauritius or a Singapore.
Okay, thank you. I also request the participant that if someone can wish to directly have the interaction with the speakers and the panelists, so they can raise their request to raise their hand, and then we will unmute them to start interacting. Let me take the next question, which is from Mr. Tushar Somaiya. He's asking that what does Category 3 Alternative Investment Fund mean? He has also requested to explain different categories of AIFs.
So basically, there are three different categories, 1, 2, and 3 of the AIFs. Now, the first two categories would predominantly invest into certain other kinds of securities, which could be either in the unlisted space or specific to certain kinds of particular activities, which are based on in different kinds of investments. The exemptions that are available through the GIFT City in terms of the tax benefits, as mentioned in the income tax law, are specifically to the Category 3 alternative investment funds. That is why the investments that are channelized through this vehicle are structured in this Category 3 AIF route, so that all the benefits which the objective of the government is in order to provide by way of the inbound investments are available. Having said that, Category 3 AIF through a GIFT City is not just restricted to the GIFT City. Category 3 AIF is a very broad-based kind of offering, and there are several different Category 3 AIFs which invest into either equities as well as derivatives, or only derivative strategies, even in the Indian jurisdiction, which may not have the kind of tax exemptions as the GIFT City AIFs have, but have got several other objectives and a lot of participation even otherwise, because the advantage is that GIFT City has got a structure wherein the individual need not comply need not do all the kinds of different compliances, and the compliances are the responsibility of the fund. So the fund pays the taxation, does all the kinds of compliances, and the investor need not worry about that. So that is also another opportunity in this category 3 AIF domain, which is available over and above the GIFT City route.
Okay, thank you. Now I have a couple of questions into one, and the question is that are there any options available other than AIF, like PMS, or maybe investing into direct stocks or directly into mutual funds? So through GIFT City. So can you just give your insight on this?
So at present, as far as the entire regulatory framework is concerned, and to take advantage within that framework of the IFSC regulations, as well as the keeping in mind the income tax exemptions, all these benefits are restricted to this structuring through an alternative investment fund, that too specifically category 3 with the different kinds of conditions, fulfillment of different conditions, that is through creation of a fund management entity, so on and so forth. So the other kinds of investments at present are not available as far as the GIFT City are concerned, because the regulatory framework as of now is not conducive of those kinds of routes. Having said that, in future there could be certain other offerings in form of a retail participation through a PMS or a mutual fund kind of offering that may be announced by the regulator. But so far it is restricted to AIFs, that too with this kind of a minimum ticket size, investing into the securities, the class of securities that we discussed.
Just to add to what Rajit said, basically, I would say that we have maybe a mutual fund and a PMS offering. The route is the Cat 3 AIF. As far as the products of what Mr. Manas and Mr. Vaibhav said, the underlying investment is anyways into mutual funds. So say somebody investing directly into mutual funds or through this Cat 3 AIF, which provides the advantages of taxation and those regulatory parts, the underlying investments is into mutual funds. And these mutual funds, which we have been talking about, have got very extensive, large track records, and track records which are really enviable. The product which Motilal Oswal, Mr. Ritesh ji said, is basically a product which is very much similar to what a PMS would offer. No? So all these products, maybe a mutual fund or a PMS, are available, but the difference is that for regulatory reasons and the tax reasons, it is offered through the Cat 3 AIF route.
Okay. So on the similar line, like there is a question by Mr. Kotaria that he's asking for the past track records of these funds. So the mutual funds which will be investing through the AIF would be considered to be the track records in order to have the evaluation of the investment offerings of AIF.
Yes, very much. Say the HDFC Flexica fund is, of what I understand, is a 50,000 crore fund already. It has got a fantastic track record, and maybe the funds of Mirae, which are being contemplated, also has got very fantastic track records. So, and those track records are in public domain, you know. So anybody can have a look at those track records, and the underlying investments is going to be into those respective funds.
Okay, thank you. Now I'm just reached to the last question from the chat box, and that is regarding to the conversion charges. Like say the investments will be made in USD. So if somebody in Singapore is about to invest into this offering, so from Singapore to USD, and then will it be like from USD to INR, or are there any is there any information available for the related conversion charges on these currencies?
So the way it would flow is that firstly the investments are denominated in USD. So from the home currency, which could be the STD, the investments would get converted and translated into USD, which is the currency of denomination. Now, since these investments are eventually rooted in the Indian financial markets by way of either investments into units of mutual funds or equity shares, and these options, which are the mutual funds and equity shares, are denominated in INR, since they are being traded in India. there would be a conversion which would happen indirectly via the fund route when the fund invests into these mutual funds or equity shares. So ultimately that conversion would happen. So that is something which would always happen. But the advantage behind this is that the kind of volumes which the funds would have in terms of the foreign exchange flows out of the different kinds of investments that they would be having would be quite encouraging to have a much more competitive rate of conversion into the INR. But that would always happen. It might be a little challenging to find the exact kind of conversion rate which would be available for that particular investment. But on the whole, that rate of conversion could be much more encouraging and could deliver a much better return in terms of the currency exchange aspect is concerned.
Okay, thank you. Now the last question, which is from Mr. Dipesh Shah. He's asking for the ticket size. So at present it is 150,000. So maybe are there any chances that in future we can see a decline in the minimum ticket size, or what are the possibilities?
So at present, the minimum ticket size is $150,000, which the IFSC regulator has announced, with the idea that basically all the investments that are routed through all these tax havens of family offices, of high net worth individuals, can be redirected to the Indian jurisdiction by way of GIFT City. And that is the kind of target audience that the regulator has kept in mind. And that is why the ticket size has been comparatively high than what the retail participation size would be. If any of the panelists have got some idea in terms of the timeline as to when the regulator is planning to reduce the ticket size or introduce more kind of offerings where there is retail participation, then please throw some light on it. But as of now, this is the only kind of offering that is available.
So ideally, we should not speculate on the regulator. I mean, it's the minimum amount mentioned, and we have to follow it. So in the future could happen, but we don't know, and so better not speculate. And let's see.
Yeah.
Okay, fine.
Just
So
wanted to add, for example, we also have a FME retail license, which means we can accept retail mutual fund applications in future. I think there's a tax difference of getting money in a Cat 3 IF versus a mutual fund structure in the IFSC at the moment. Once that is sort of sorted and the regulatory framework becomes much easier, all of us will be able to start accepting even retail applications. So I would see that in the very near future, the ticket size for investors will go down quite considerably, and our license also permits us to start accepting retail money from investors. So once it is done in the income tax laws, I think so that should happen very quickly. Let's hope for it.
Yeah, and what we have been seeing in last at least 4 years, every day or every little time, there is something which is coming up. And as I said initially, the regulator and the intent of the government is full of agility. So they are quite receptive of what best that they can offer in terms of making India a better place, or maybe a comfortable place for somebody to invest into. And so, just what we can say is that abhi bahut picture baki hai. So many things are yet to come, and that's the way the progression is happening.
okay, thank you all. I have posted a feedback form in the chat box. Everybody is requested if to give us your positive feedback, maybe positive or anything, but we hope that if you can just help us with your feedback so that we can keep ourselves improve, and it keeps us motivated to come up with such webinars and events for investor education and awareness.
Special thanks to our esteemed panel for taking out time on a weekend and answering all the questions and giving a very, very wonderful insight.
Thank you so much. It was an honor being part of this panel, and hope this continues, and anything that's required, do reach out to us if there's anything which me and the other panelists can help us even after this discussion is over.
Thank you so much.
Thank you.
Thank you.
Thank you. Bye-bye.